Thanks for tuning into Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Mr. Dean Kin. He's the head of research product at William O'Neill and Johnson right now to talk about the global correlations and how is it that they at William O'Neill are thinking about emerging markets in general, India in particular, and the correlations that various asset classes, including currencies and commodities, have on our markets. Dean, great having you. Thanks for joining in. Hope all is safe.
Thanks for having me. Pleasure to be here.
Now, the pleasure is ours entirely. So, Dean, tell us, the equity markets have been in a bit of a risk-off mode, naturally so, because of all that's transpired in the last 15 days in particular. But even what was transpiring over the course of the last couple of months with all the supply chain disruptions, a COVID wave here and there across the world, what's your sense of how much of the negatives are priced in? Or would you reckon that 2022 promises to be a volatile year because of inflation, interest rate scenarios, and what some people now fear, a stagflation scenario, if not anywhere else, then in Europe for sure?
Yeah, great question. I mean, a lot of things are going on right now, obviously with the conflict in Europe, Russia and Ukraine, that has sent, for example, oil prices spiking to near historical high, and that has repercussions across the globe. A couple of months back, as you mentioned, we were dealing with inflation, and Fed was definitely on the course of raising rates successively, which had the market sort of, take a knee-jerk reaction, start to become volatile, and then we throw on the Russia-Ukraine conflict. And now we're looking at a market that's, potentially heading into bear market. So a couple of things I look at. One is, where are we with respect to the yield curve, particularly in the U.S. The 10 to 2 year or 2 to 10 year yield curve continues to flatten. We were above 100 basis points, let's say 2-3 months ago. Now we're only down to 24. I think we touched 20 basis points today. And so that is quite concerning because as the yield curve inverts, meaning it goes to negative, that is a indicator that would suggest that we may be looking at recession, 12, 16 months down the road. We don't know when Russia-Ukraine situation is going to be settled, but if it continues on for the next 6 months, let's say, I think there's going to be tremendous pressure on the market. And if the yield curve inverts, then we're looking at a recession scenario come 2023. So that's something that we're looking at very closely. Obviously, the oil price is a huge concern. It's starting to become a concern in the US because gasoline prices are heading towards, in California where I live, it's above $5. A lot of the market participants are sort of forecasting above $7 per gallon. And that's not going to be great for US economy either. So a lot of things are sort of pointing in a negative direction, and including, our market in the US, both S&P and NASDAQ, were kind of in a downtrend. We're looking for a follow-through day, meaning, a day where we could see evidence that it could climb out of this downtrend, but we're not seeing it yet.
Dean, how high is the probability of that recession that you were talking about? And depending on that probability that you attach to that event in 2023, what is your current stance on different asset classes, particularly equities?
Yeah, I mean, I think, equities market will definitely react prior to we see, evidence that indeed we're in a recession, because equity markets tend to be leading indicator. And so I think a lot of the market participants will keep an eye on the 10 to 2 year yield curve spread. And, there's other things that, we could take a look at in terms of high yield bonds. There's an ETF for that. and that is spiking to the negative side. We also have VIX, which is a indicator for volatility. That's spiking at the moment. Interestingly, gold is breaking out, so that's an indication that definitely the market is moving more towards safety. And so when you look at all of these things combined, I think the market is kind of bracing for sort of recessionary period ahead. But we're not going to know for sure until we definitely need to see the 2 to 10 year yield go negative. If you go back to history, you go back to 1970, and every time there's a recession, about 12 to 16 months prior to that, we had a euro curve go negative. So it's a very strong indicator, and hopefully we're not going to see a negative spread, but the way things are going, it could be a possibility.
Dean, the template for the last some quarters, maybe some years, whenever we've hit periods of news which are potentially very negative for equity markets, is that somehow central bankers have found a way to bring us out of it. Now, I'm not saying their actions are aimed towards equity markets. Their actions must be aimed towards the economy at large, but the equity markets get a whiff of it. And central banks, we have been in a central bank-driven bull market. If indeed there are fears of a recession, if indeed inflation does stay high and central banks are forced to act on the interest rate side, is there something else that can be done which can come to the rescue of the markets? Or do you reckon that this time around, the equity markets will first drift lower before they find a sweet spot?
Yeah, I think that scenario is a definite possibility because we're seeing it now. We're seeing equity markets retreating, but definitely the central bankers, like in the case of the U.S., Jay Powell, I think he may take a step back in terms of the plan that he originally had, given all of the situation that's going on. He may be slightly more dovish. I don't think he can back away from raising rates because the inflationary problem is a particularly thorny one. But what he could do is he can slow down the rate hikes, and instead of going every month or every other month, perhaps he can go once a quarter. That's something that the market may be looking for, something to alleviate the pressures coming from all sides. We're kind of in a well, I don't want to use the term unprecedented, but in previous economic slowdowns, the Fed had the monetary policy ammunition where they can lower rates quite successively and cause some liquidity event in the market. But currently, it's kind of difficult because of the thorny inflation problem. Now, one could argue that this is a supply constraint based inflation, which could be a possibility. But so far, supply constraints haven't been resolved, and we're still dealing with the inflationary problem at the current moment.
Okay, now let's kind of take the focus a little bit on India, Dean. The most obvious tactical trade, ceteris paribus, is that if oil is higher, tactically India should be, there should be an underweight stance. And I think some brokerages, Credit Suisse, for example, yesterday did that. I want to understand, of course, what are you guys at William O'Neill? What is your stance on India? And is the recent correction and is the incessant selling from FIIs over the course of the last few weeks, months, already baking some of those pressures in, or could there be more?
Yeah, that's a great question. Definitely oil has a negative impact, or the rising price of oil has negative impact to the economy. But one thing, I think we should all look out for inflation or, CPI, see where that's trending. So far, India has been able to manage the CPI quite well. I think it's below 7%, which is quite phenomenal. If I look at the Sensex, for instance, and I see the lows of I guess the day before your time now. If that were to be sustained as a low, and the market can build up from here, I think India, the market has a chance to rally again. The lows established the day before is a logical low. When you look at the chart, that's where you should find the index buying support. And so if we can maintain that low in the coming days, weeks, and months, then that's a great sign, because that will have been the bottom. Yesterday India had a great day. We'll see what happens today, but on what we're looking for now would be a follow-through day. So on day 4, if the market can go higher than the previous day, and the volume is more than the previous day, then we can look forward to sort of the market establishing a low the day before. I think instead of trying to predict where the market's going to go, what we do at William O'Neill is we take sort of a present approach and taking a look at the chart and see where we go from here. But I'm hoping that in 3 or 4 days we'll see a follow-through day. Now, if the follow-through day fails and we establish a new low, then that just means that the market is not ready to accept the fact that all of the things are being priced into the market. So if the oil price continues to spike and stay elevated, then we could very well see a new low in the market. But I'm hoping that this follow-through day is going to work.
What are the Dean, based on I know there is going to be earnings cuts coming in for India for FY23, arguably even for quarter 4 FY22, but for FY23. But based on a reduced earnings scenario and a reduced multiple scenario, what are the levels on the benchmark Nifty or the Sensex, whichever you track, is where India starts looking attractive enough to commit some money to?
Yeah, I actually, that point is already being priced into stocks, in my view. First of all, India is a fantastic, equity market, because there's a lot of growth opportunities. When you're looking at banks, for instance, they're growing organically 20%. You don't see that kind of growth, anywhere in the globe. It's only in India. You also have very strong rising middle class segment of the economy, and that's great for retail and consumer names. But when we take a look at some of these stocks that should be growing 20-30% organically, the share price is retreating, and they're falling below the 200-day moving average. So I think a lot of these is already being priced in. So when does it become a new a low? I think for the index, when I look at it, so yesterday the index bounced, and that was at a logical point where the index should bounce. So the key question now is, can it sustain itself? If it can, then that means the market has already priced in all of those factors, including earnings revisions or earnings downward revisions. But we'll have to see. I think it'll take a couple of weeks before we know.
Dean, do you have any thoughts on the quantum of FI selling that India has seen? Because I take on board your point about banks. Are they growing organically after a reasonably lackluster period of consolidation? 2022 promised to be the year wherein banks will see substantial earnings growth as well, subject to no other COVID waves. but the FI selling dampens any kind of hope. And of course, there's also this change narrative of if indeed India's capex doesn't come on stream as planned because of all the changes in finance assumptions, then that earnings story gets delayed a bit. But be that as it may, what's your thesis about the FI selling and the impact that it has on the largest weightage, which is banks?
Yeah, I think banks will continue to be under pressure because 3 months ago, globally, all the countries were starting to reflate, and all the central banks were raising rates. Now here we are, we're in a different scenario. We have the conflict in Europe, we have oil prices spiking, we have inflation problems. And there's definite risk towards economic growth, in every country. And so central banks, I think they're kind of in a tough place at the moment because at the same time, they have to deal with rising inflation, but they also have to care about potentially, slowing economic growth going forward. So, for that reason, I think banks will take a back seat for this year, and perhaps the banks will come back in 2023, but I don't expect banks to outperform anytime soon. As far as FIs, I think when oil prices start to retreat and they start to stabilize, that's when you're going to see FIs coming back into India. Right now there's too many negative sentiment or negative catalysts for foreign investors to come into the market. I think it's too early for them to come into the market. I think oil prices, first of all, will need to settle down, and that we don't know when that's going to happen. That may take months, but I think as soon as we see some signs of oil prices kind of stabilizing, that's probably when foreign investors are going to probably start to come in.
So the panacea for all ills is reduced oil prices.
I mean, it certainly does. Yeah, that certainly does have direct impact, but also it's also a signal, in my mind, for outside investors to start looking at India again.
Okay, Dean. Before we thank you, I'm really tempted to ask you, based on your past experience as somebody who looked at smaller businesses very, very closely, and India having a plethora of some of the most promising small cap and mid cap themes. I don't know if you've looked at it as closely, but based on purely the themes, a marriage of charts as well as fundamentals, what within the smaller universe sounds the most promising to you? Again, I don't know if you look at those at all, but I'm still asking. If you don't, then you can very well just tell us.
Yeah, that's a great question. I mean, I tend to focus on stocks that have more liquidity, because that's the kind of names that I kind of recommend to clients and so on. But if I were to look at themes, for the future, I mean, right now, obviously, it's all about basic metals, energy, oil and gas, but I am noticing pockets of interesting names, such as like Balrampur Chini. It's a sugar company. It's a smaller cap. The chart suggests that it wants to break out. Another one is Sun Pharma. That's probably a little bigger, but some of the healthcare names, they're starting to look more attractive. And so I would maybe 6 months down the road, we'll start to take a look at retail names again. And there's a lot of smaller retail names in there. But India is a fantastic equity market to look at for sure.
Yeah, it's very interesting that somebody who looks at global markets, for William O'Neill, is looking at a small sector called sugar in India. The fortunes of that seem to be changing.
Yeah. It's you just can't beat the earnings growth, the environment that's in, valuations and so on, and everything tells itself through the chart. And right now that stock, it's looking like it wants to break up.
Fair call. Dean, lovely talking to you today. Thank you so much. I wonder why we took so long to talk, but I'm glad we've spoken for the first time and look forward to having you much more on our platform.
All right. Pleasure to be here. Thank you very much.
Now, thank you for your time. And viewers, thanks for tuning in to this edition of The Talking Point.